ever looked at a set of financial statements and wondered, how does an auditor actually know whether these numbers are real, complete, or even recorded in the correct period? Well, that's exactly where assertions and audit procedures come in. But before we jump into one of the most important topics in audit planning, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss a chance to master technical CPA concepts with me. All right, let's dive right into the heart of audit planning: assertions, procedures, and how auditors use them to respond to risks. When management prepares the financial statements, they're not just typing numbers into a system. Whether they say it out loud or not, they're making claims, or what we call assertions, about every account and every transaction. Auditors use these assertions to guide their risk assessment and to design appropriate audit procedures. Assertions are grouped into two main categories: assertions about account balances, balance sheet, and assertions about classes of transactions, income statement. CAS 315, Identifying and Assessing the Risks of Material Misstatement, provides a guide of these assertions. Let's break them down one by one. And to make this super practical, I'll show you the exact assertion, the risk if it's violated, and an example of a procedure that addresses that risk. These assertions relate to the balance sheet: assets, liabilities, and equity. Here are the 6 assertions. 1. Existence. Question: do the recorded assets, liabilities, or equity actually exist? If this assertion fails, the account is overstated. Something is on the books that isn't real. Example: sending AR confirmations to customers. 2. Rights and obligations. Question: does the entity really own these assets? Are the liabilities truly theirs? This becomes important for things like consigned inventory, assets pledged as security, factored receivables. Example: inspecting loan agreements to confirm whether the bank has rights to pledged assets. 3rd, completeness. Question: is everything that should be recorded actually recorded? If this fails, the account is understated. Example: performing a floor-to-sheet inventory count to ensure all goods in the warehouse are included. 4. Accuracy, valuation, and allocation. Question: are the amounts recorded correctly and measured in accordance with the accounting framework? This covers things like AR collectability, warranty accruals, amortization, impairment. Example: inspecting subsequent cash receipts for overdue AR to assess collectability. 5. Classification. Question: is this amount recorded in the right account? This applies only within balance sheet accounts. Example: reclassifying customer credit balances from AR to liabilities. 6th, presentation. Question: are amounts properly grouped, disclosed, and understandable? Think of things like current versus non-current debt, required disclosures, contingent liabilities. Example: reviewing legal letters for provisions and disclosure requirements. Now that we've covered balance sheet assertions, let's look at a real scenario to see them in action. Gadget Hub is a large electronic retailer across Canada. They rely heavily on keeping the latest devices in stock. Recently, the CFO mentioned that they've overestimated the demand for certain older tablets. The risk? These tablets may no longer be saleable at cost. If so, the inventory should be written down. Relevant assertion, accuracy, valuation, and allocation. This is a perfect example of how assertions help auditors identify exactly where something could go wrong and design procedures to address it. Now we move over to the income statement. Here, we have another set of 6 assertions. First occurrence: were the revenues and expenses real? A violation overstates the account. Example: vouch payroll expenses to timesheets. 2. Completeness: was every transaction that should be recorded actually recorded? Example: tracing sales invoices to the general ledger. 3. Accuracy: are the amounts calculated and recorded correctly? Example: recalculating interest expense using confirmed rates. 4th, cutoff: were transactions recorded in the proper period? Example: inspecting shipping documents around year end. 5. Classification: are the expenses recorded in the correct income statement category? Example: ensuring advertising expenses aren't recorded as interest. 6th, presentation: are revenues and expenses disclosed and broken down appropriately? Example: reviewing contracts to confirm proper revenue disaggregation. Let's look at an example of improper revenue recognition, a classic CPA exam scenario. Modanova sent free fall winter inventory to its retail partners in September. Retailers didn't have to pay until after June 30th of next year, and only if they kept the goods. Modanova recorded the full amount as revenue immediately. Relevant assertions, occurrence, cutoff. Why? Revenue should not be recognized until the retailer sells the goods or the right of return expires. Once risks are identified, auditors must design procedures that respond to those risks. Per CAS 330, procedures must address the nature, timing, and extent of testing. 1. Nature. This refers to the purpose and type of the procedure. Is it a test of controls or a substantive procedure? And what method will you use? Confirmation, inspection, inquiry, recalculation. 2. Timing. When is the test performed? Interim. Year end. After year end. Example. Subsequent receipts. Subsequent payments. Some procedures must be done after year end, such as reconciling the financial statements to the accounting records. Third extent. How many items will be tested? This depends on materiality, assessed risk, desired level of assurance. Higher risk, more testing. Audit data analytics can also increase the extent of coverage. Now let's explore the two main types of audit procedures auditors rely on. Tests of controls. These procedures evaluate whether controls are operating effectively, used only when control risk is low, and the auditor is taking a combined approach. Examples include checking whether journal entries were reviewed, approvals were documented, reconciliations were performed. A deviation means the control didn't operate, not that a misstatement exists. Substantive procedures, these detect misstatements in the financial statements. Two types, tests of details and substantive analytical procedures. Tests of details examples, confirming AR, agreeing PPE additions to invoices, recalculating depreciation. Analytical procedures. These analyze relationships among data, efficient but cannot detect specific dollar errors. A good procedure must clearly state 1. What the risk is and why it matters. 2. What the procedure is. 3. How to perform it. The structure is verb plus population plus document plus purpose. Example, recalculate depreciation expense for a sample of vehicles and agree the amounts to the GL to ensure accuracy. Before we wrap up, here's a quick cheat sheet you can screenshot, save, or use when studying for the CPA exam, or when planning your audit approach in real life. This summarizes everything we covered today. 1. Balance sheet assertions, account balances. Use these when assessing assets, liabilities, and equity. Existence. Does it actually exist? Rights and obligations. Does the entity own it or owe it? Completeness. Is anything missing from the balance? Accuracy, valuation, allocation. Is it measured correctly? Classification. Is it in the right account? Presentation. Is it disclosed properly? 2. Income statement assertions, transactions. Use these for revenues and expenses. Occurrence. Did the transaction really happen? Completeness. Has everything been recorded? Accuracy. Is the amount correct? Cutoff. Is it in the right period? Classification. Is it in the right category? Presentation. Are disclosures appropriate? 3. Nature, timing, and extent. How you design procedures. Nature, type, and purpose of the procedure. Test of controls versus substantive. Techniques like inspection, confirmation, recalculation. Timing, when the test is performed. Interim, year-end, or post-year end. Extent, how much testing is needed. Sample size, coverage, level of assurance. 4. Types of audit procedures. Tests of controls. Check whether controls worked as intended. Used when control risk is low and a combined approach is taken. Substantive procedures. Tests of details. Target specific items. Example, confirmations, vouching. Analytical procedures. Evaluate relationships and trends. 5. How to write a strong audit procedure. Think verb plus population plus document plus purpose. Example format. Recalculate for a sample of X items sing source documents such as invoices to confirm accuracy. Valuation. Cutoff. etc. 6. Common risk areas and related assertions. Here is a table with the main areas, key assertions, and why it matters. 7. Real-life examples to remember. Old inventory, valuation risk, free goods with return rights, premature revenue, subsequent payments, finding unrecorded liabilities, credit balances in AR, classification issue. 8. Quick exam tips. If the issue is overstatement, think existence, occurrence. If the issue is understatement, think completeness. If it involves measurement, think accuracy, valuation. If timing is the problem, think cutoff. If disclosure is the concern, think presentation. Always connect one risk to one assertion to one procedure. 9. Big picture takeaway. Assertions tell you what could go wrong. Procedures tell you how to find out. Together, they form the backbone of an effective audit. If this video helped simplify assertions and procedures for you, feel free to like the video, subscribe, and share it with another CPA student preparing for the exam. Thanks for watching Canada Accounting Insights. See you in the next video.